Hey everyone. If you're a short-term rental property manager or thinking about becoming one, understanding your financials is absolutely essential. Today, I'm walking you through a sample profit and loss statement for a property management company with about 80 units under management. We'll go section by section so you know what to include, what to look out for, and how to use your P&L to run a smarter, more profitable business. Let's start with revenue. This is one of the biggest mistakes I see on P&Ls. You should only show property management income here. Booking revenue belongs to the owner, not your management company, so it should always be excluded from your financials. What you do want to show here are all the ways your business earns money. And ideally, you break those out into individual line items like we can see here. This gives you clarity into which revenue streams are working and allows you to benchmark yourself against industry standards, which we'll cover in a later video. Here's a quick revenue line item breakdown. The management commission income, this is your primary income stream from bookings. Typically, this is charged to homeowners as a percent of nightly rent. Next is cleaning fee revenue. This is paid by the guests and retained by the management company in this example. Best practice, don't include this on owner statements. We recommend treating this as a management company revenue and cost, which leads to cleaner owner statements and less questions from owners. Other guest fee revenue, these are things like damage waivers, early check-ins, late checkout fees, pet fees, processing fees like from Stripe, and resolution payments. These are all items that are typically retained by the management company, but in some instances may be shared with homeowners depending on how your agreements are structured. Lastly, we have onboarding fees. These are charged to homeowners for setting up a property. Don't do this for free. And then technology fees. These are monthly charges to cover the cost of your software stack. This level of detail helps you understand your revenue drivers and compare them directly to related costs, which we'll go through in the next section. Next up is cost of goods sold, also known as COGS. This includes variable expenses, costs that increase or decrease with your booking volume. Here's what's typically included in this section. Contract labor, housekeeping, this is usually your biggest COGS item. This is what you pay for turnout cleans. Supplies, consumables, these are things like toilet paper, dish soap, other restocking items. We've got OTA and channel commissions. These are payment processor fees like Stripe or guest book in advance. These are charged back to owners through processing fee line item in revenue, but there's often a timing lag between when the guest pays and when the fees are charged and when they're actually recovered from the homeowners. Last is rental insurance premiums. If you offer damage waiver to guests, this is where you record the cost of that protection. Some key comparisons to look for here, your cleaning revenue versus your housekeeping costs. Make sure you're not losing money on cleans. And then your damage waiver income versus your insurance premium. Again, making sure you're at least covering your cost, if not making a small margin here. These comparisons can help you evaluate the profitability of each of your service lines and identify places where you might need to adjust your pricing. Last line here is gross profit, which is revenue minus your cost of goods sold expense. Now let's look at operating costs, your overhead. These don't change much month to month and aren't tied directly to booking volume. The highlights here, advertising and marketing. This could be everything from Google ads for direct bookings to referral payments. Insurance. This is insurance for your business itself, not to be confused with damage waiver insurance. Legal and professional fees. These include things like your accounting costs, like Keystone, legal fees, and then other professional fees. This might include VAs or overseas contractors, which could also be broken out into a different line item depending on how you structured your P&L. Payroll, if you have in-house staff, this is usually one of your largest expense categories. And if you're an S Corp, this is also where you'd find your W-2 owner compensation. Software and apps, things like PMS systems, messaging tools, dynamic pricing software can all be found here. And then you have your remaining miscellaneous items, things like travel, meals, and utilities, small but good to track individually. By separating these from cost of goods sold, you get a better sense of what it costs to simply keep the lights on each month. Last up, we've got non-operating items. These are not part of your core business, but still relevant for a complete picture. Other income, things like credit card rewards or miscellaneous rebates. Other expenses can be things like education, conferences, charitable donations, expenses that aren't routine business costs but are still worth tracking. These help you arrive at your true net income, which is what's left over after all expenses are accounted for. So there you have it, a complete walkthrough of a property management company P&L. This isn't just about bookkeeping, this is about strategy. Use your P&L to make smart decisions, price your services right, understand your margins, and keep your business healthy. If you want help building a P&L or want monthly reports tailored to your STR business, that's exactly what we do here at Keystone Bookkeepers. Check us out at keystonebookkeepers.com or shoot us a message. Thanks for watching.